Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. If today were Friday, Dan, it would be Friday the 13th, but it's Monday. The old saying, if the queen had balls, she'd be the king. The king laughs. He had to, if you know that whole saying. Do you know that saying?
Yeah, sure.
It is 1 o'clock on the East Coast. The market call. Swizz here, Dan there. A big show for us today. Of course, the Knicks got thumped last night. But, you know, as it turns out, whether you lose by a point or 32, it doesn't matter. It's still a loss. They will be back home tomorrow. The Rangers play tonight. As you know, Dan Nathan will be in attendance. How are you?
I'm doing great. I'm fired up. This is the deciding game for
No.
Well,
Don't
guy,
say
but
that.
that's your jam.
Don't
I'm just telling you. I'm feeling pretty confident about it.
It is game. Listen, they're up 3-1. It's game.
Yeah.
All it is game 5. There's nothing. There's not. It's only decisive if they win.
Yeah, well, they're going to win 4-3. So there you go, and they're going to have a few days off before they get to round 3. How's that, guy? All right,
well,
you're making me dizzy, and it's not because of all the references.
I'm Morang. My shirt is Morang.
Yes, it's amazing.
So after this show ends, and before I get in the car to the city, I'm gonna have to change my shirt. Otherwise, I'm gonna get yelled at by the powers that be at CNBC.
Yeah, you might do. So we come in here, Guy. It's mid-May here. You know, we're kind of midway through the Q2, right? We got some earnings this week I think are kind of interesting. We have some Fed speak. Some of your main men and women are going to be chatting it up this week. We got the CPI on Wednesday, plus retail sales. And then, you know, a week from Wednesday, I think it is, a week from the CPI, we have NVIDIA's earnings. And you know, interesting news out there. We're going to talk about the semis a little bit. Well, should we just do it? Should we just?
Well, let's look at the rundown, and yeah. I'm going to read 75% of the rundown, and I'll let you guess which one I won't read. Yeah. So the rundown for today: key inflation reports this week. That is true. It's always the key. It's like the all-important jobs report. This
Correct.
is key inflation. Apple's AI play. I mean, they're seemingly floundering with that, but I mean, the market likes it today. JP Morgan fills in the gap, and
yeah, Roaring Kitty ignites mean mania, whatever.
Yeah. Those are words you will never probably hear me say.
No, but you know what? I think when we get to it, it'll be interesting. We don't have to talk about the name that ignited this rally, but there's some other stuff going on that I think it makes sense to kind of, you know, just kind of connect the dots a little bit here, Guy. S&P, you know, at least the cash was very near those prior all-time highs. The futures, a little bit of a flag here, consolidating a little bit here. It just seems like we got through Q1 earnings season, Guy. We had that sell-off. We had some early, one of the reasons we're going to look at JP Morgan again, you know, there were some big early gaps lower in some names that we were focused on. Netflix was one of them. Meta was one of them. JP, they all kind of filled in those gaps. Amanda could have done Mind the Gap a little bit, Guy, but we got there. You know, the S&P, you look at this chart, I mean, you and I thought, we thought we'd probably get down at least 10%. We got down about 6% or so. But, you know, I guess the question that I have, and especially in a week where, you know, there's some key data, you know, that is likely to move rates a little bit, is like, what could possibly happen this week or next that would cause the S&P not only to get back to those prior highs, if you just look at the E-minis here, but to kind of catapult a move meaningfully higher? Because here we are, the S&P cash is up almost 10% of the year again.
Okay, so a couple things. I think you get stunningly soft inflation data, which the market champions as the Fed's done their job. And, you know, in fact, we've ratcheted rate cuts back to maybe one or two. And then maybe it goes from 1 or 2 to 2 or 3. The market will love that. Or, you know, and you wishing for this, but something in the Middle East there's some sort of olive branch ahead of this potential move into Rafah that has been very well telegraphed. Those are the two things off the top of my head. And, you know, technically, if Amanda can do this on the fly, if we can do, instead of the static chart, a real-time chart with a 50-day moving average thrown in there, you know, I guess in a certain degree it makes sense, because if you look at the S&P, that sort of downdraft down in the middle of April basically took us down to the 50-day moving average, which we held and sort of bounced off of. You know what? My bad. We actually violated it and traded back through it. I actually thought we held. So here you go. So, maybe we're doing some work at the 50-day here. What I think, Dan. The 50-day is flattening out. I think it's going to start to trend lower. And I think 47.50, which is effectively the 200-day, is going to be tested.
Yeah, earlier I was on the Tape podcast with Liz Young, EY from SoFi, and we were
And
talking, strategist calls. It seems like most of them, Guy, have kind of thrown in the towel at this point here. And this was from Stifel. It was Barry Bannister who was saying, and I love it. I love a guy who makes a call, or a gal makes a call like this. He said the next 500 points in the S&P 500 are going to be lower. He gave a handful of reasons. He talked about the benefit of the kind of mini recession that we had from 2022 into 2023, that, the markets have kind of benefited from the disinflation, right, of that period. And he sees, again, as we get through earnings and we get through some of the other data that will affect rates and the like, that the S&P will react negatively. And I guess the reason why I posed that question to you, though, about like what is the thing that could get us through the highs and then make a meaningful new high, establish a new range above it, and it's got to be something on the rate front. And so let's just pull up the CME Fed Funds tracker here, because again, we went from 6 expected cuts this year to 3 to then 1, and now it's to be kind of building back up again. The 10-year yield, maybe we can pull that chart up a little bit, Guy. It seems like it's found a level just below, or I guess as you would say, either side of 4.5 or so. You just see that 200 down there. Maybe we test that on slightly kind of weaker inflationary data. But again, like inflation on a cumulative basis, as you made the point on many occasions, and as it seems to be, kind of working into consumer sentiment a little bit, it just doesn't matter if we get slightly lower prints. You know what I mean? Like, we're just not going to have a meaningful sort of print anytime soon. It has to be a number of prints strung together, right, that suggests that rates should be going much lower that much quicker.
Yeah. And that's why I mentioned, the inflation data may potentially, coming in soft. And then obviously that would then make rates go lower, which the market would champ. I agree with you on that. And look, I guess the moving average here probably comes in around, 4.32% or so. I'm sort of eyeballing it. Each day it gets probably a tick or so higher. But you can look at it. I mean, if your eyes go back to February, I mean, you can still see that we're in this uptrend or so in terms of yields, downtrend in terms of the TLT. And you can also look at it and say, you know what, not only is this uptrend intact, but you're in this channel that, again, probably started in middle to late of December of last year. So it all sort of makes sense, I guess. I'll say it, and if I'm wrong, I'll be the first person. I still think the inflation data is going to disappoint. I still think it's going to come in hotter than people expect. I don't think the market's going to be particularly fond of that. And we'll see what happens to rates, on top of which you have a bunch of bond auctions coming up as well. So I remain in the higher yield camp, and I remain in the higher yield camp, not because the economy is doing so well, but because of other factors at work that should not necessarily be, I guess, beneficial for the stock market.
Yeah, and I guess if we just kind of think about corporate earnings and what we heard out of Q1 results and Q2 guidance, is that, we just kept on hearing about a resilient consumer, but, there's also plenty of data that's talking about the excess savings rate coming down, consumer credit going higher, resetting at much higher levels, all the trade down sort of commentary. So under the hood, it just seems like if the consumer is 2/3 of our economy, it seems like they're getting kind of tapped. And, if you just think about what McDonald's and Disney and Starbucks and a few others had to say, and even some stuff on the high end, whether it be Lulu or Gucci or something like that. I mean, at the end of the day, it just, there's not a really clear narrative that if the Fed was able to lower interest rates, that would be a meaningfully beneficial thing to the U.S. consumer. I'd also note, Guy, that, the U.S. dollar chart looks very much like this 10-year yield chart. The crude oil chart looks very similar to, you know what I mean? So we're kind of at some critical levels at some really important kind of macro inputs, if you will, especially as it relates to the inflation front.
I agree. And you're right about the dollar. I mean, it's the same chart effectively. I mean, you're still in this uptrend from earlier this year. The channel you can see, I mean, Amanda can draw it if she wants, but that's intact. And it's interesting. I know it's not your words necessarily, but the resilient U.S. consumer, you hear that that is the adjective that the market wants to put in front of the consumer. I don't think it's resilience. I think it's their need to spend because they have to survive. But its transactions are up. Clearly, you see it through MasterCard and Visa, but that doesn't speak to the resilience of the consumer. Again, my opinion, it speaks to the fact that they're fighting inflation basically with debt. And you see that over and over again with credit. And if that's a resilient consumer, if that's what you want to label it, that's fine. I think it's anything but.
Well,
But
yeah.
that's neither here nor there.
No, I listen, it makes sense, but when companies are reporting their results and they're gonna, like, and they're tracking over month, quarter over quarter, year over year, whatever it is. I mean, like, that's the word that kept on being used, except if you were McDonald's, Starbucks, Disney, Nike, that sort of thing. So to me, I think that differentiation is really important. The other thing I'll just say is that this week, maybe they can throw up the earnings chart and some of the data chart. Like, tomorrow morning we're gonna have Home Depot. And, this is really interesting to me, like juxtaposed to Walmart, which is going to report on Thursday. And maybe they can pull up a Home Depot chart on the fly here, which is down about 13-14% from its 52-week highs. It's down more from its all-time highs made a couple years ago. And now let's flash over to Walmart. And so Walmart is a story that we've been talking about for over a year, talking about this trade down effect. And look at this, how resilient this stock has been, even in the face of that 6% downdraft that we saw in the S&P 500, about a month and a half ago. It really had been consolidating a bit. Yeah, it had been trending a little lower. So here we are threatening a new all-time high, as we head into the print. So again, benefiting from a trade down consumer. And then the flip side, Home Depot, you know what I mean? I'd say is more discretionary, right? So you got to feed your family. You got to put clothes on their back. You're looking for a cheap way to do it, right? In a high inflationary environment. But Home Depot, you know what I mean? Like, there's probably lots of stuff that you can do or not do around your house when things get tight.
Go to a longer term chart of Home Depot, and this is it, if you think about the timeline of what was going on in the world, this actually makes sense. I mean, a Home Depot obviously created with everything else at the beginning of COVID, and then magically, as people obviously were stuck in their homes, this stock went on an epic run. Which, think about it, makes sense. People were spending on their house, made a lot of sense. They had a lot of money in their pockets for a myriad of different reasons we don't need to get into. And the stock made an all-time high. You can see it right there. I mean, I want to say, Dan, was it the fall of 2021 or so?
Yep.
And then it's obviously since then, it hasn't traded particularly well. To your point, recently, absolutely not so well. But over the course of the last few years, not so well as well, which, again, I think makes sense given the backdrop. I think you're right to say, this is probably very discretionary in terms of what people are buying as opposed to a Walmart. Walmart wins in this environment. But I will tell you, if you hear something out of Walmart that sort of raises an eyebrow, in other words, maybe the average basically wage of their consumer going up from $100,000 to whatever, and then you can start to connect more dots and saying, there's a huge trade down going on, and it's affecting a wide swath of people. So when you hear it from McDonald's, maybe it's anecdotal, but when you hear it from McDonald's, Nike, Starbucks, and across a swath of different retailers, then you say, you know what? There's something endemic going on. And, I'm hard pressed to believe Home Depot's going to crush it this quarter, but I'm more interested to see what Walmart has to say.
Yeah, I'm in the same camp as you as far as Home Depot, but I would say this, one of the things that's interesting and all weekend long, on the A1 of the Wall Street Journal, at least online, was an article about rents nationally, right?
Yeah.
And how it's more expensive. And so I wonder, and I don't really understand, all the dynamics that weigh into the housing, but like, so maybe if you are in a home and you do have a locked in mortgage rate, that's pretty good, right? And so, maybe that is causing you obviously to do some upgrades or this and that, whatever. Who knows? But does valuation, Guy, like Walmart, for instance, trading about 25.5 times fiscal 25, mid to high single digits expected earnings growth, and same sales growth is about 4% expected, that sort of thing. Is that an issue? Because one thing I'd say, remember when Costco reported, I want to say about a month and a half ago or so, that stock had just come off of an all-time high. Obviously, we know that's look at that, a fairly, expensive stock in the retail space, had that big gap lower. You see the stock as Walmart over that period of time since last earnings, was basically consolidating, in and around a level like higher than where they had just reported. This one was consolidating and moving lower, right, from that all-time high. And now look at it. It's making a new all-time high. Now that's one on valuation. You could make the argument, okay, like they have that, 4% recurring revenue. That's the club fees and everything like that. Great, high margin, all that sort of stuff. But some of the stuff that we saw in the Costco results, as far as their same-store sales or the comps, wasn't particularly great. So that's one reason why I'd be a little nervous about Walmart here, because if they are able to put up a big quarter and guide up, it probably doesn't say a whole heck of a lot of great things about some of their competitors. It says how they are managing inventories, how they are solving to a consumer that's trading down.
Yeah, and their margin is going to be, this is now Walmart in terms of, what they have to pay their workers and those types of things. So I think you're right to bring that up. Listen, valuation is one of those things, and I know you know this, but it's not a concern until it is. And Walmart historically has been expensive compared to its peers, for example, at Target, and justifiably so. But, Walmart wins in this environment. I mean, that's just the reality of the situation, and they speak to that. I think the only thing that can sort of hurt them now is not necessarily, the same store sales numbers or volume numbers. It's a margin number, which, if that comes in disappointing, that will speak to their inability to pass the cost on to the consumer and the problem that they're probably facing in terms of their input costs vis-a-vis wages. So that's just something to sort of, again, look at. I'm with you on the Costco. I mean, Costco had a dramatic sell-off. It's come raging right back, because I do think in this environment, both Walmart, I should say this. I think the market feels that both Walmart and Costco are very defensive.
Well, yeah, but Costco trades at 48 times.
No, listen,
I
get
know
it.
it's defensive from as far as inflation is concerned. I mean, that to me looks like, I don't know, maybe tomorrow, when we have our friends from Fidelity sponsoring, and we highlight a few options trades. That one might be something we take a look at here, because that looks like an epic double top. And again, it's just kind of rising tides, maybe sort of situation, guy, because I can't put my finger on something that is that beneficial. And everything you said about margins as it relates to Walmart, relates to these guys too. And again, I don't know how much cheaper their gas is at Costco, but gas prices are not, I mean, they're still pretty elevated, right? And it just seems like the sort of thing where, people, if you're paying more for gas, you're probably paying less for stuff, or your share of
it's
that part is going. Yeah, exactly. So at some point, who knows? How do you think the market's positioning into the CPI on Wednesday morning? Like, what do you think?
I don't
want to see.
Yeah, I don't think it's look. 2-3 weeks ago, to say, it's positioned actually really well when you saw that pretty dramatic sell-off in the S&P. But since then, obviously, we've come raging back. So, I don't think it's positioned. Let's put it this way: I don't think it's positioned for a hot number at all. So, the expectations, I would imagine, at these levels are for a soft CPI and then subsequent PPI on Wednesday. I don't think you're going to get it. So if you're asking me, which you are, I don't think the setup is particularly good. And I'll say this as well. When the market was, and again, this is just today, I understand that one day does not a trend make, but I thought it was interesting today that the VIX was up all day long. The market was up at one point. I think the S&P was up 18 handles or something, nothing huge, but up nonetheless. And the VIX was probably up, around 13.5, 13.75. Now, you can say it was, pushed down all of last week, and maybe it's just gotten back some of Thursday and Friday's losses, I guess. But, the VIX was telling a story earlier today that seemingly right now, at least, the market is picking up on. So we'll see. But to answer your original question, no, I don't think the market is well positioned at all for potentially could be a hot CPI number.
Yeah. And again, on the rate thing, it's kind of interesting to see what groups of stocks are kind of banging around, you know what I mean? Like where they were about a month ago when we had a 10-year that was 4.7, and now we have a 10-year that's 4.47. One name that kind of caught my eye, I've been kind of tracking a little bit, because I think back on April 12th when they reported, this is JP Morgan, that 6% gap or so. Look at that. I mean, this is not a stock that has had too many gaps of that size. It's the largest bank in the world. We get what's going on there, but the fact that it kind of recovered, guy, and filled in that gap, it's consolidated. Now it's making a new run for its all-time highs. Do you think that the money center banks, do they benefit that dramatically from a decline in yields right now? Because again, we get the ones that had these mark-to-market, held-to-maturity, issues with treasuries, and so yields coming off helps them. But that's not the situation with JP Morgan.
Yeah, we have found ourselves, I think, in this environment where if rates go higher, people flock to the banks under the premise that higher rates theoretically should be beneficial for the banks. As rates go lower, the market rallies and the banks get dragged up by the same forces, right? So it's sort of right now, I think they find themselves in a win-win situation. I don't necessarily think that's correct, but I think to a certain extent that's what's going on. You said we created this gap to the downside. By the way, it's interesting again, the implied move of JP Morgan after earnings was, I think, 3.2%. We had a whole conversation about it. I think they reported on a Friday, and we said, it doesn't make a lot of sense given the run the stock it had. And I think that we wound up seeing like a 7.5%, 8% move. We've gotten the entire thing back now. So I guess the question is, are we going to fail at this prior level? You just mentioned Costco. I mean, this is similar to the Costco chart, right? You had a big run up, precipitous sell off. It's gotten the entire thing back. Is it running out of steam here into the number tomorrow? Again, this is a bank. This is not a tech stock, but it is trading like that. I mean, these are utilities effectively, and they're trading with, they're trading in a way that historically banks don't trade at. That's just my opinion. So it's not an indictment of JP Morgan. It's more an indictment of the market, I think.
Yeah, no doubt. All right. Speaking of tech stocks, Guy, OpenAI is hosting an event today. A bunch of whiz bang cool things that I'm sure are going to be, you're going to like line up at the application
Yeah, I'll be
store
there.
to get on your iPhone
There's
here.
one in there's one by the Pierre Hotel, that Big Apple store.
Yeah, yeah,
Across the street. There used to
right
be where
across from the
GM was.
plaza and the pier.
Yeah,
Yeah,
yeah.
it's right
And then
there.
and then they have an application store on the second floor. So it's
Correct.
very convenient.
Very convenient. So OpenAI is hosting this event. Now, interestingly about OpenAI, we know that Microsoft's made like a $13 billion investment over the last 2 years. They've had, a lot of exclusive access to building in their generative AI technology into their search, but also into their productivity suite. And again, we don't have to go through all that, but it's interesting that as Apple really was not involved in generative AI for all intents and purposes. Obviously, they've been spending a lot of money on machine learning and what they've done with Siri and some other stuff, their neural engines and their chips and all that sort of stuff, but they don't have a product that consumers can use, right? And they've really started to change the narrative. They've been talking about it after not talking about it at all last year. They're talking about it a lot, but they still don't have any products that consumers want to use. So the idea that if they were able to, license OpenAI, put it on their next iPhone, it's not going to cause an upgrade cycle. Just like it's not going to happen. But it is interesting that Google is down today. I don't know if you saw that. So let's pull up an Alphabet really quickly. There were rumors a couple weeks ago that they might license Gemini. We also know that Apple has this exclusive search deal for Safari. They have an installed base of 2 billion iOS devices. So Google pays them a very high margin to have that search business run on iOS. So the idea that they would do a deal with Gemini, which is the large language model from Alphabet, made a lot of sense. So the stock's down on that. Thoughts on all this? Because tomorrow is Google's I/O. That's like this user conference, Guy. They're going to talk about a lot of AI sort of stuff here, but a lot of stuff going on here. And again, we might not know anything until we get to June 10th, which is Apple's Worldwide Developers Forum, which they speak to developers, and they're basically going to like make all these announcements. And then they're hoping that they will be developing in and around this ecosystem.
All right, so let's throw up that Apple chart again, because I do think it's somewhat interesting. I mean, Apple was obviously not trading particularly well. They report that quarter. Everybody gets excited by, again, I'll say it, the fact that it was better than expected. It was shitty, but better than expected. So it was less shitty than people thought. And, that's just factually true in terms of Apple. And the fact that they announced that $110 billion stock buyback, which I think got everybody sort of jazzed up, you saw the gap higher. I mean, we've created this gap, but I don't think necessarily anything's changed. I mean, now you have 4 out of 5 or 5 out of the 6 last quarters, you've seen negative year-over-year revenue growth. So that's not encouraging. I think margins seemingly have bottomed out but it's not like they're upticked in a major way. I think the one good thing about that quarter, the Apple quarter, was the fact that services are now north of 25% of overall revenue. However, if you're nitpicking, you could say, well, yeah, that's a good thing. The bad thing is you're not seeing, if revenue was growing the way it should be growing, we'd still probably be in the high teens or the low 20s in terms of overall revenue to Apple. So it's like everything else. If you're bullish, you can make it look great. If you're bearish, you can say, you know what, these are the reasons you should be negative. I look at this and say, we created this bit of an island here. One bit of bad news, an open below sort of 182, and then we're having an entirely different conversation. But if you just crunch the numbers, nothing has really effectively, in my opinion, changed at Apple.
Yeah, no doubt. I mean, I think you and I were both in the camp. I mean, without that buyback announcement, the stock's not rallying the way it did that day. And now there's obviously some enthusiasm about what they might do with generative AI into the conference. So I was kind of hoping that, China would be, at least the guidance in and around China would be worse. I mean, the quarter in China was slightly better than expected, as you just mentioned, but China's 20% of their sales. And when you think about some of the nationalistic tendencies and the tariff wars and the trade wars and all this sort of stuff, Apple is really not going to get out of this unscathed, in my opinion. So this seems like a really short reprieve. And if there's not anything meaningful that comes out about like the licensing deal with whoever they end up doing it, I think the stock fills in the gap. I just thought it could be a good trade, guy, if you had this thing, back below 170 after a disappointing report and guide. I don't think they do themselves any favors by having the stock up on this big gap, in my opinion, because I think whatever they announce, investors are not going to be able just to hang out until the phones are really released in the fall. You know what I'm saying? So, and that's the only story here. And you saw this hubbub that was made. I saw you tweet about it, about this ad that they put out last week.
I was one of the first. I'll say flat out. I mean, I'm usually last to shit, but I saw that ad. I'm like, somebody. I don't know what my tweet was. Maybe Amanda can find it. And I'm like, I don't know who thought this was a good idea, and then who subsequently thought they should put it. It was one of the worst ads I've ever seen. I mean, talk about dystopian society.
Yeah.
I mean, Apple put this out, and then next day they pulled it. They said, "Our bad." Now maybe that was the plan all along to create some buzz around it, but
I don't
that
think
was
so.
shitty.
I think it was a bit of tone deafness, but there was interesting guy that a guy that I read, Ben Thompson, who's widely read in the tech community. He runs a site called Stratechery, and he said one thing. And I mean, listen, it's pretty hard to find anybody who's going to say, yeah, that's a great ad for what it represents. But at the end of the day, one of the reasons why I think he felt that there was so much, debate over is that it really touches a nerve, right? It really, if you're creative, if you're this or whatever, it really, I mean, and by the way, if you go and look, Tim Cook still has it up. Like, they pulled the ad. It never made it to TV. I'm sure it was meant to go to TV over the weekend, that sort of thing. But he still has it on his Twitter, which I think, well, there it is. I mean, Amanda's pull it up. So that's kind of interesting. But again, it just tells you, I mean, what this says to me, guy, the fact that so many people are so fired up about this is like, this is all coming. You know what I mean? Like, this is a very, very disruptive sort of trend when you have massive companies like this with the resources that they have trying to make things happen in this space. So for whatever that's worth, that's my
no. It's all good. I mean, I hated it, and
I'm not defending it. What I'm saying is that if it wasn't so accurate, I think it wasn't such a risk to like people's livelihoods. You know what I mean? I don't think it would have struck the same chord.
No,
what I mean?
that's fair.
What about Alphabet really quickly, guy?
I'll stay in my foxhole in the 1950s. Now, look, I mean, I think Google's the one that we've talked about for a while. I mean, this is, to me, you don't run that far away from Google. I mean, valuation is still reasonable in this environment. They still have a tremendous moat, I think. Unless they totally miss the mark. I mean, this is a stock that I think you sort of stay with it and try to buy it on rallies. I mean, there's an uptrend in place since March. You can draw the line. Maybe you get a pullback and fill in that gap down to 160 or so. I think the stock's trading, about 166 now? But I don't think you run that far from Google. And we've been pretty, I think, steadfast on that one.
Yeah, no doubt. Really quickly, NVIDIA, Jeffries puts a $1,300 price target on it, or $1,200 or $1,300 price target. They say that, they think that they can earn 45% above what the street is expecting next year. They're in their current fiscal 2025. It's already expected to be up 90% year over year. The stock is up nearly 90% on the year. I just think that's interesting. But then the split screen here, guy, is that there was an article in the Information this morning where Chinese regulators are telling Chinese companies buy Chinese GPUs. Now, this comes after all of the regulations that the U.S. has put on against manufacturers of these high-end GPUs and their ability to sell into China. So I do think it's interesting. We saw this a little bit with Apple, you know what I mean, over the last few months. And then the other one I'll just mention, which I think is really interesting, is that remember a couple months ago when Elon Musk was talking about how Chinese EVs are just going to destroy everybody else. They're cheaper, this, that, whatever, and they better put some big tariffs on them. Well, the Biden administration is talking about putting 100% tariffs on Chinese EVs. Now, I'm going to just steal a line from you, Guy. Careful what you wish for with that, because again, Shanghai and the Gigafactory there is, meant to be a disproportionate amount of the sales of Tesla outside of the US. Now, you can't put a tariff on a car that's made in China, but there's a whole host of other things you can do, especially if we're starting to see nationalistic tendencies towards some of these consumer products.
Yeah, I mean, there was an aluminum tariff I saw. Again, what do you expect to China? Listen, just so crystal freaking clear. I was born in the United States. I consider myself an American, just so we understand each other.
Yep.
But what do you expect the friggin' Chinese to do? I would do the same friggin' thing if I were them. You're going to say, you know what, buy American chips? That's fine. What are you going to think is going to happen in China? It's going to be this is going to continue. Now, you start connecting dots. You say, okay, who's going to come under the crosshairs if this thing gets ratcheted up? And the answer is companies that you've seen already: Starbucks, McDonald's, Apple, a handful of other names. So if you don't think that's happening, you're just not paying attention. And you can say, why would they do that? I mean, why wouldn't they do it? Yeah. So, I mean, that's what's happening. Again, maybe the Biden administration should do this. Obviously, the Trump administration did similar. I think it obviously it's one of those things that you can, I think it's somewhat, in terms of political, I think it's everybody's sort of in favor of it, right? The question is at what cost? And I don't think that's what the market is fully prepared for.
Yeah, but you know what the irony is, Guy? Is like I just can't see U.S. consumers buying 23,000 Chinese, like $23,000 Chinese EVs. And especially if this is done, I'm sure the Biden administration doesn't really care much about Elon Musk. They've not had a good relationship. But when you think about, protecting, let's say, Detroit, okay, well, here's the thing. I mean, Detroit has moved away from, they're going heavy into hybrids, which I think is really interesting. So, again, it's interesting. The news in Tesla, though, Guy, and we were talking about this a little bit earlier, it seems so helter-skelter right now. So 2 weeks ago, Elon gets on a plane and he goes over to see Vice Premier Lee, and he comes back with this, this supposed announcement about full self-driving. That got that stock going back up on that move. Then, they announced that they're going to kill the Model 2. That is the low-end EV that was meant to compete with all these cheap Chinese ones. Right as it sounds like the reports this morning, or late last week, right as it was like ready to go into some sort of beta thing that they pivot to robo taxis. Then they fire their entire their entire supercharging group of people, even the person who ran that. And then the announcement today is they're bringing some of them back. Okay. Like when you think of that and you think of the tariff situation, it's like, it seems like a little bit helter-skelter over there right now, Guy.
Well, I mean, it's reeks. And one thing you didn't add, I know it's not that you forgot to, but the fact that weekend of the Berkshire Hathaway shareholder meeting, Elon Musk, I think he tweeted out or something to the effect of, Berkshire Hathaway should be buying Tesla stock. And that to me just sort of reeks of desperation. I mean, it's one thing to say the Berkshire Hathaway meeting was this weekend. We obviously know that Warren Buffett and everybody at Berkshire Hathaway is aware of Tesla and what we stand for. And I hope they see the value that we see as well, and at some point make an investment. I mean, that's fine, but that's one way to handle it. The other way to handle it is sort of the pathetic way, pick me, Monty type of thing. Again, it sort of reeks of desperation. And we talked about this, and you said it into earnings. It was a bad press on the short side to continue to press Tesla down. It traded down to a level, quite frankly, a level that we thought it would trade down to, and bounced. It bounced probably 40% or so, maybe 45% off the lows. And now we've given half of that back. So if you pull up that Costco chart, you'll see it. I mean, we're in a series of lower lows and lower highs, and there it is. So this has not been broken yet.
Yeah. No,
excuse me. Did I say Costco? I meant Tesla. I apologize.
No, and we're going to do an update tomorrow on the market call, we detailed a bearish trade that we put on in the options market in Tesla when the stock was 180 last week. It got to about 168. And we're going to adjust that position tomorrow. I think we kind of have it right where we want it, Guy, as far as the entry and some of the catalysts. We're really focused on that Q2. This would be early July delivery number, which from what I'm reading, it looks like it's tracking worse than Q1. And that was an absolute disaster. And you think about that gap lower below that sort of 180 level at the start of April, it was because of that Q1 delivery number. Guy, one last thing before we get out of here. I know these are not words that you're going to say, but a guy that I follow, I think he's coming on Fast Money this week too. A guy named David Buell from Baycrest. He does a really good options newsletter for institutional clients. Last week, he highlighted some options activity, short dated in and way out of the money, okay, in GameStop. Now, when I saw that, I just glazed over it. I'm like you, I could care less about the meme stuff. You and I are both in the same camp. A lot more people, if you go back to 5 years, a lot more people lost money than a handful of people that got a lot of notoriety for identifying it back in 2021. It's interesting though, about a few weeks ago, Guy, the stock was trading at 995. That was the lowest level, okay, then since before it took off in that kind of meme thing, you know what I mean, back in January 21. So you got out of the money call buying, short dated, and then this guy roaring whatever kitty, like puts a tweet out last night. He comes back to Twitter, and this is what happens. So again, if you're a trader and you love this sort of price action and you know how to get in and out of it, have a ball, do whatever the hell you want. You know what I mean? But all I know is that a lot of people were the bag holders following this guy in, and all that diamond hands and all that bullshit that went on. You know what I mean? I think a lot of people learned their lesson, but right now with 25% short interest, this guy's got it going again. And the other point, I'm not going to ask you to comment on this because I know you don't want to, but like, look at Robinhood. It's benefiting today. If this is where a lot of this retail activity goes on, you know what I mean? So there's a whole host of names. AMC is up 20 or was up 20% when I was looking at it. So they're all in again. You know what I mean? To me, that's really bearish though. I know that people are going to try to make money on the long side. I think it's bearish for the overall market.
Well, we've seen, it harkens back to a few years ago when we saw similar activity. It speaks to market structure. David Einhorn wrote about it a couple months ago. Doug Cass talks about it all the time. All this is, look, I don't think there's anything here that was illegal, but man, oh man, it reeks of really, it's just poor taste, this stuff. I don't know who these people are, but clearly they position themselves for something. One of these people puts out that tweet knowing the type of the reaction they're going to get. And quite frankly, they're probably harvesting those gains today on the back of as you called them, sort of bag holders. Nothing has fundamentally changed at GameStop or AMC or any of these companies. So, yeah. But if you were fortunate enough to get on the back of it, that's the reasons why don't matter if you're making money, right? I guess they matter for the conversation at the cocktail parties, but whether it went up for the reasons you thought or different reasons, if you own the stock and it's higher, good for you.
Yeah, the only point I'll make is that, we started doing our podcast, this one, the predecessor of Market Call, and on the tape, I think January of 2021, right? And at the time you had, crypto, NFTs, all this Reddit crap and all these names. And at the time, you and I and Danny and, whoever else was on with us were really skeptical about it. And we know that these things can go on a lot longer, right, than any of us would probably like. But the reason why, we'll talk about it every once in a while is like, this is a buyer beware sort of situation. And, understand that while these guys are getting everyone hopped up on the internet and saying, we can do this, stick it to the man, to your point, they're taking profits too, right? It's a big game. So whatever. I also think that at the time, we thought that all that activity across all these different risk assets was really bearish, and not because retail was doing it, right? It was more that it's just like these things can't last. And if you have this over exuberance, they usually overcorrect the opposite side. And that is exactly what happened. And it also led us to believe that, the underpinnings of the market were just based on too much, unusual euphoria, if you will. So I'll just leave it at that.
No, it's all good. We're going to talk about it here. Obviously, we just did. We're going to talk about it on Fast Money tonight, for better or for worse. And, that's the market that once again we find ourselves in. But, not to bury the lead, it really does come down to market expectations for the following 2 days in terms of CPI and PPI. Has the market run too much? Have yields come off too much? And if you get a hot number, what's going to happen? We're going to see a 13 basis point move in 10-year yields back to maybe 464. And will we see the commensurate move in the S&P? The VIX was at a tell this morning. All those things are things that I'm looking at. But we're going to know a lot more this time tomorrow, Dan.
This time tomorrow. We love that.
Isn't that's a Metallica song, right?
No, it's from the Kinks. And the Kinks is a band that should be right in your wheelhouse.
Not really.
No? Okay. We covered a lot of ground. That was a lot of fun. Tomorrow we have Carter Braxton Worth joining us. We'll do a little Tesla update. Maybe we'll do a little Costco trade using the options. Who knows? Let's get crazy.
We'll update some trades for sure. I won't wear a shirt that Moray's, and that's what you're seeing is the shirt Moraying. It's the stripes.
Wait,
that's
Guy,
a technical term.
Before we get out of here, you started the show by saying that if today was Friday, then it'd be Friday the 13th. And I was trying to figure out where you're going with that. But on this day, May 13th, 1985, a song by the same name as the album came out by a band that you really love. And it's not something that, like most people have in their top 10 sort of list. I mean, most classic rockers. But
May 13th, that sounds like Dire Straits to me.
Bang. And what was the album called?
Well, it was the first Dire Straits album. It was just Dire. It wasn't making movies. It was
it was Brothers in Arms.
No, Brothers in Arms was.
I'm looking at it on the internet.
Oh no, but that wasn't their first album.
It's their fifth album.
Yeah. Brothers in Arms, you're right. And the song Brothers in Arms is a wonderful song. It was featured on that show with the guy with the white jacket and the other dude, the two cops from Miami. What were they called that show?
It's called Miami Vice.
Yeah,
now,
Miami
by the way, Miami Vice, to me, that show is like, on the Mount Rushmore of network shows over the last 40 years. And they had so much awesome music. They had Peter Gabriel Biko on their opening, on their pilot. They had In the Air Tonight from Phil Collins. And then Phil Collins was in there, it was just a lot of like awesome cameos, a lot of amazing music that was like first run sort of stuff. Nowadays they don't do that anymore, Guy.
How many Phil Collins songs or Genesis songs do you think are on my
Zero. Yeah. But
Phil
you know
Collins
what? You say this, but he was prolific in the 80s. He was probably one of the biggest pop stars between Genesis. Guy, he was between Genesis and then and I know that you love that song, Studio. You do. I know you do.
One of the worst songs in the history of mankind. No, sir, I don't think I say this about who's that guy that just got into Rock and Roll Hall of Fame? Dave Matthews. Dave Matthews doesn't like Dave Matthews, and Phil Collins doesn't like Phil
Matthews. I love Dave Matthews, and I love Phil Collins, but Studio was probably, to your point, was a horrible song. What about the other the other guy who took over that Phil Collins took over for in
Peter Gabriel.
Peter Gabriel. And that song Sledgehammer, I think it came out around the same time. They both got really dually poppy, and that's a pretty bad song too.
Peter Gabriel.
Red Rain off of that album. Red Rain is an amazing song.
That's Peter Gabriel.
Yes, off of that album that Sledgehammer was on. It might have been called Sledgehammer. I can't remember.
Peter Gabriel, before anybody knew who he was good. The Peter Gabriel, that's everybody that sells out, that's why we're not sellouts.
Maybe AD will put the Brothers in Arms video in the
these mist-covered mountains are all left for me. I mean, it's a haunting song, brothers. It's a great album, haunting song.
Yeah.
Just saying.
True that. All right.
That was fun. We're back tomorrow.
Listen, don't more on Fast Money.
I'm changing the shirt.
See you later. See you, everyone. See you tomorrow.